Good afternoon, everyone, and welcome to Landbay's webinar on the UK economy. We're joined today by Simon French, who joined us, I think it was last June or July, last summer. Simon is Managing Director and Chief Economist at Panmure Gordon, where he's been for almost 8 years. He's also, you may have seen, a sort of regular has a regular column in the Times and has done for the last 5 or 6 years. And prior to that was an economist in government and has a master's degree in economics from Durham University. So obviously lots to discuss today. Obviously there's lots of things that have changed since we last spoke. Particularly sort of obviously around inflation and energy prices that have caught us all by a little bit of a surprise. But I will pass over to Simon now. Like last time, we'll please do. We've got some questions that have been sent to us ahead of time, but please do feel free to submit questions as you go. We may do some questions on the way if they're topical, and if not, we'll pick them up at the end. So please feel free to submit questions. As I say, we'll either do them as Simon goes through his slides, or we'll wait for the end. So on that note, Simon, I'll pass over to you.
Thank you, John, and thank you everyone for taking your time this afternoon to join us. As John said, this is my second invite to speak to Landbay webinar, and I'm delighted to be invited back. And chatting with John a couple of weeks ago about what we wanted to cover, certainly the theme du jour is inflation. It's visible in almost all parts of the economy. It's across the news headlines, a number of things triggering of price increases that we haven't seen in at least 30 years. And so that's going to be the, if you like, the lion's share of the presentation, but with a constant reference back to what that means for the UK housing market. And some looks later on at some of the fiscal policy, tax and spend choices that the government has been making and will be forced to make, I suspect, later on in the year. So in terms of structuring today, you should have the slides presented in front of you, but there are four main sections. As I say, the first section is very much the big picture one, looking at the outlook for interest rates, what that means for the UK housing market, and GDP, UK economic output. Then looking at the real tight fiscal tightrope that the Treasury government has to navigate at the moment. Fiscal policy spending has taken a big responsibility in guiding the UK economy in the last 2 years. What does that look like going forward, given some quite sizable tax increases, some of which came in today, and some of the challenges, longer term challenges, agnostic of what's happened on COVID regarding public spending. We'll look specifically at the impact of high energy prices, and then finish off with a look at the spring statement, which it's difficult to believe was only 2 weeks ago, and is probably why the Chancellor's gone off to California to have a bit of a rest, because it's been a fairly fraught 2 weeks in terms of the question whether enough has been done to insulate particularly poor income households, low income households from the impact of this energy squeeze. And we'll leave 10, 15 minutes at the end for a lot of questions, and I'm delighted to hear you've already submitted a lot of questions, which is great, because having done these webinars the last couple of years, on occasions you get stunned silence or lack of questions at the end, and I think more than 20 have already been submitted, so that's great, and we'll try and get through as many of those as we can, so I'll leave some time at the end. So on interest rates first, central banks are responding, these are the key messages, to what is a really difficult trade-off for them. Raising interest rates when most of what is driving inflation is externally derived from international energy markets is a really difficult trade-off. For the housing market, there's still huge demand as a result of shifting preferences, what economists call the utility value of property. It's gone up during the pandemic as people have spent much longer in their homes and have thought that homes will increasingly be proxy offices for them. So that utility value is still driving demand, but clearly there are some things that are going to start to suppress demand. We'll explore that. And then GDP, we don't think there'll be a recession. Reminder, a recession is defined as 2 successive quarters of negative output growth. We don't think there'll be a recession this year, but it will feel for many people like a recession, and I think that will be the real challenge, how the economy evolves for many people might not necessarily be reflected in the data. And I said I'll recap quickly. I've said at the bottom here, I'll recap from our June 2021 webinar, what I actually said then and what has aged well and what actually has aged badly. And the title that John gave me back then was The UK Economy Bounce Back or Boom. And we said it would bounce back strongly, but we were unconvinced by some of the suggestions of a roaring 20s, where the economy just rushes ahead, unencumbered like the 1920s, at least the 1920s in the United States. I think we got that bit largely right, or largely right thus far. But to be even-handed, I would also say we failed to see inflation on quite this scale. Back in June, looking at my forecasts, I expected UK inflation to peak out around 5%, consistent with the peaks that we saw after the global financial crisis in 2009, and then when commodities hit a previous all-time high in 2012. Both occasions, UK inflation hit about 5%. But because of extraordinary goods inflation, you can see this on the right-hand side of page 4, running now at 8% and likely to go north of 10% as we go through the summer. That is a level of inflation which we didn't foresee, driven by some extraordinary moves, not just in energy markets, but in broader commodity markets. And of course, the risk is that interest rates, central banks are going to have to respond. And that really is where we're going to kick off this presentation, which is to talk about interest rates and what both the market is seeing, but also what I see personally. So on the left-hand side here, you've got what is known as the market curve, or market pricing for where UK interest rates are set by the Bank of England will be in a 1, 3, 6, 9, 12-month view. Now the market, that's the dark blue blocks, see interest rates increasing from their current 0.75% to 2.5% a year from today. So 2.5%, 175 basis point increase is a further 7 interest rate increases from here. That's quite a considerable amount of interest rate increases. And I'm going to go into why my own forecast is still for an upward trajectory, but for a slightly more gradual pace, albeit it will take interest rates to levels we haven't seen since 2007, early 2008. 1.75% for many people won't, in historical terms, look like a high level of bank interest rate. Even 2.5% won't. But actually, for a whole generation, maybe even a couple of generations of borrowers who are really quite unfamiliar with those levels of interest rates, if either the market curve or indeed my expectations play out, that'll be quite uncomfortable in terms of the additional cost of servicing debt with obvious pass-through to quoted mortgage rates. It's important to say, and I end up shouting either at Twitter or the TV a lot of the time when you see commentary, economic commentary, that tries to make a lot of what we're seeing in the macroeconomy at the moment too much UK-centric, too much about domestic choices, our domestic economy. It has to be said, what is going on at the moment is largely a global phenomenon. What we saw last month in March is 75% of central banks around the world raised interest rates, including the Bank of England. And that is the highest level, certainly for 25 years, which was kind of when most central banks, most of the major central banks gained their operational independence. Now, that clearly isn't taking rates back, absolute interest rates back to anything like the levels in the 90s and early 2000s. But that pace of change, coordinated across the world, is certainly a phenomenon that we're now seeing, and I expect we'll see for the rest of the year. Moving to slightly more, not just the policy rates set out by central banks, but actually quoted rates, the kind of quoted rates that lenders are offering. There's been a long-term decline, certainly over the last 6 or 7 years, 1, 2, 5-year, indeed 10-year fixed money declining on average. It's lumpy, you can see on the left-hand side here at page 6, but generally on a downward trajectory. What you've seen in recent months is quite a significant noticeable rebound in short-dated money, 1, 2-year and 5-year money, all back up to around 2%. What's interesting, I find fascinating really, is 10-year money, not wide products widely available, but certainly the quoted rates as given by the Bank of England suggest that actually long-dated money is still falling in nominal terms. Why is that? Well, to some extent, that's just reflecting what we're seeing on global bond markets. Investors are prepared to accept lower interest rates on long-dated money than they are on short-dated money. It's known as a yield curve inversion. It's big parts of the financial services sector just are in awe of what are known as yield curve inversions. I'm not going to go, there may be opportunity for questions about what a yield curve inversion does. But what it tells you is that long-dated money, lending to governments, lending to banks on a long-dated level is you're getting a lower interest rate than short-dated money. So that spread is narrowing. That's certainly a feature of what we've seen in recent months. And certainly I expect that to continue given yield curve is showing no signs of steepening. The other thing to look out for is although interest rates, perhaps the policy rates, while they're going up, may not go up to levels we've seen pre-global financial crisis. I don't think we will get to there. What you are starting to see, and the Bank of England has to be said is the first of the major central banks to start doing this, starting to sell its debt. The debt that it has bought, known as quantitative easing, it's reversed. It's starting to do quantitative tightening. The moment it's just not reinvesting gilts that mature, but come May, it may well start to actively sell gilts back into the market. Of course, if the Bank of England is no longer a big marginal buyer of gilts, that pushes up interest rates for gilts and pushes spreads for secured, unsecured lending, corporate lending up. And that is one of the features we expect in the United States and in the UK to be a feature of why perhaps bank rates, headline interest rates might not go up as much, but that monetary tightening will take place anyway through selling of assets that central banks have been buying very readily in the last couple of years to try and support the economy. Third and final bit on interest rates before I move to the housing market specifically is just to, I guess, to buttress why I think that while interest rates going up, the scale may be limited. We may get to 2.5% in the UK. Eventually, we may get to 3.5% in the US, but probably not going to retrace to much higher levels. Why? Partly because very high oil prices, very high energy prices have historically, it's quite a busy chart on the left-hand side here at page 7, but if you go back over the last 50 years, when oil prices have been high in real terms, that's the oil price adjusted for inflation, the dark blue, very volatile line. It tends to be when that happens, the global economy slows down. And the red bars are when global growth has fallen below 2.5%. And of course, with energy prices high right now, there is a very real opportunity, a very real chance, indeed it's our base case, that growth starts to slow, meaning the demand for a lot of goods and commodities that have been pushing up inflation start to slow and effectively do the central bank's job for it by bringing down inflation and therefore limiting the amount of interest rates. It's somewhat of a circular argument, and clearly you have to remain credible of doing some interest rate increases if you're going to have that effect. But that's what I talk about, the uneasy trade-offs facing central banks at the moment. They have to try and deflate their domestic economy to try and deal with the terms of trade.
Simon, can I just ask one question on this? Because particularly around sort of oil prices, is how much of this sort of increase in oil and other energy commodity prices is supply constraints that might come around because of sort of lockdowns and then subsequently, obviously, the war in Ukraine versus actually just consumer demand because of the bounce back of the economy? Or is it a bit of both?
Yeah, so I think it's more a demand story, which is not where we've been used to the oil market being in disequilibrium. We've tended to see geopolitical disruption drive out supply, say in Libya or Venezuela, or disruption in the Middle East, and a bigger supply story. The rebound we've seen most recently has been the rapid reopening of economies, meaning the demand for oil has particularly in China and particularly in broader Southeast Asia, has actually driven some of this increase in prices that we've seen. So I think it is much more of a demand story than perhaps the previous iterations of energy price spikes we've been familiar with, which were much more supply constrained. And what I'm going to do is just to finish off this section on interest rates by talking about what we're seeing in the UK is consumer confidence, which have rebounded exceptionally fast after the COVID pandemic has now retrenched to levels that we last saw in the depths of the COVID pandemic and indeed during the global financial crisis. So consumers showing some signs of hunkering down. And of course, that is why the bank is going to be cautious of adding to consumer caution through raising interest rates at a very fast pace. So moving to the housing market specifically, again, I mean, at the risk of sounding like a broken record, the UK's house price inflation, not just most recently, but actually in previous iterations of house price spikes, they largely follow what we see across the rest of the G20, G20 being paradoxically the 19 of the biggest economies around the world. So that big pickup in UK house price inflation has been a global phenomenon. And arguably, if you speak to contemporaries in Canada or New Zealand, United States for a period of time, parts of Europe, they have seen house price inflation at and indeed exceeding the levels we've seen here in the United Kingdom, suggesting that while there is an awful lot of focus on the supply of housing in the UK, planning regulations, help to buy, things regarding stamp duty, actually, the UK doesn't look out of kilter, at least not on my charts, of a broader shift towards A, finance being very cheap during the pandemic, but also this rush for space, for seeing a higher utility value in housing. So with that in mind, important not to look at the UK housing market always through a domestic lens, because the global financial cycle and indeed utility that people see from housing is going on around the world, and the UK is just simply not immune to those forces. There are warning signs in terms of valuations. I pick a basket of valuation benchmarks, but if you track UK nominal house prices against nominal GDP, so the size of the economy, the nominal GDP line being the dark red line here on the right-hand side, two standard deviations either way being the dotted red lines and the green lines. Well, UK house prices are the dark line here, and you can see that in 1990, they reached two standard deviations above. Ahead of the global financial crisis, they moved way above two standard deviations above, precipitating a strong pullback. We are there again. Now, it has to be said the economy hasn't fully recovered its nominal size, but that it would look at, which is over the very long term, you would expect UK house prices to the total value of the UK housing stock to move largely in line with the wider economy. And that does seem out of kilter on that measure. But
Simon, if I ask one thing there, actually, obviously during the 2020, certainly the first and second lockdowns, there was certainly this not just sense that because of the lockdowns and pandemic and that, like you say, that utility value of housing, where people look for space, where historically we've been used to London driving the UK housing market, whereas obviously the opposite seemed to be true in 2020 and maybe 2021, as people as commuting maybe became less important as people working from home, and people valued things like extra bedrooms and gardens and space, etc., etc. From what you've seen, is that still the case, or is sort of London now sort of bouncing back with the rest of the country, or is that regional variation no longer there?
It's a bit of both, honestly. So certainly the London market from its trough in, I think, probably certainly lockdown, back end of lockdown 1 and lockdown 2 was where it was really under a lot of pressure, specifically as a result of the population, not just UK population spending time out of London, but also EU migrants leaving the UK labour market. And we don't know whether that's temporary or permanent, but some of them are starting to return, fueling demand in London. And obviously employers, particularly London-based employers, starting to make more of a concerted push to get workers back into the office. But the regional strength is still the dominant feature here, actually. And I would say, yes, London has rebounded certainly from where it was, but the regional story, and not just in housing demand in the secondary market, but also primary demand in the construction sector for new build is very, very strong outside London and the southeast. It's been driven, and whether this is levelling up or not, I mean, perhaps another webinar required for that one, but new construction orders in private housing are really being driven out of the northwest, Yorkshire and Humberside and the northeast. That's where all the new order growth seems to be. So in terms of just saying we've got one metric there which suggests UK prices are stretched, there are other metrics though that don't show the same picture. And there are three ways of showing the average UK house price on the left-hand side here, page 9. Now in nominal terms, £275,000 is an all-time nominal high, but adjust that for inflation and you're where you were ahead of the global financial crisis in 2008. But adjust for, I think, my preferred measure, which is adjusting for household real income. And actually, we're still some £25,000 to £30,000 in real terms down on that level pre-global financial crisis. So there is some suggestion there that prices may not be as stretched as perhaps the commentariat suggests. And ultimately, the ability to service mortgage income or indeed pay your rent is the ultimate driver, which is why actually we're going to finish this section on the GDP outlook. And there, household income is probably the best metric of where, how the ultimate $64,000 question, how expensive are UK houses? Quick chart just to also show that the government is reaping the reward of this strength in the housing market. The last 12 months have seen tax receipts of almost £14 billion from stamp duty. That is an all-time nominal high. There were some significant surges in 2015 through 17 as stamp duty went up, particularly on second properties. But you've seen that record taken out, and it's still rising on a rolling 12-month basis. So while Rishi Sunak is worried about general tax receipts, certainly the housing market and stamp duty is providing plenty of support for the exchequer coffers. I mentioned the importance of those valuations being sustainable, coming back to the economy and indeed specifically the labour market. And if there's one chart, I think that in the whole pack, I've got 20 or 25 slides here, that I would say focus on, it's this one on the left-hand side. People on the call will remember, some of them will remember back to 1979 and the early 1980s recession, but most people will remember the 1990 and 2008 recessions. Historically, unemployment picks up, stays pretty high for up to 7-8 years before coming back to its pre-recessionary levels. That's what economists describe as the scarring effect of unemployment. Out of work, lose attachment to employers' skills, and it takes a long time for unemployment to come back down, and the economy is impaired as a result. Look at the line from 2020. We're basically back to the unemployment rate we saw pre the COVID pandemic. That is an extraordinary policy success of both furlough and the self-employment income support scheme and the interventions that were done. That suggests that the scarring this time round will be much, much lower than we've seen in previous recessions. Whatever one might have doubts about the sustainability of public spending, some of the fraud that was associated with the interventions, from a labour market perspective, you very rarely see this. I would say that is almost an unqualified success of trying to deal with a big exogenous shock to your economy by protecting, through no fault of their own, people who were otherwise going to be out of work and would take time to re-find employment. And that for the housing market is very relevant in terms of the ability, as we face higher utility bills, higher food costs, higher costs of staples, the ability to be confident that you've got a job in a month, 3 months, 6 months' time, and therefore can potentially take on additional borrowing or indeed draw down on your savings because you're confident you could service those, we rebuild those balances later on, is a key feature. And one of the reasons why I think I'm more optimistic than consensus is this really strong labour market recovery. The other chart to focus on, of course, is that the UK mortgage market just generally has been transformed in terms of its sensitivity to interest rates. If we'd been having this conversation back in 2012-13, about 72% of the UK housing outstanding mortgages were on a floating rate. Today, that's 18.5%. So more than 4 out of 5 mortgages at the moment now are on a fixed rate. Now, as interest rates go up, there will be a refinancing cycle. Those fixed rates will come to an end and they'll have to refinance at higher levels. So it is not pain averted, it's pain deferred. But in a scenario where you get a big exogenous shock, quite an acute one, the ability to be able to smooth that is one of the reasons why the mortgage market just generally is in a more structurally sound way, a resilient way to deal with this kind of interest rate and inflation increase than it had been 8-9 years ago. So I'm going to finish this section, and you'll be pleased to know the next 3 sections are much shorter, but just talk about GDP. As I say, again, for the 3rd time in this presentation, I'll say the UK is not alone in the shape of the recovery from the pandemic. It's been V-shaped. And while the G20, the light blue line on the left-hand side here, has decoupled slightly to the upside, overall that shape, given the huge noise and the way that different economies measure the size of particularly their public sector, but also the rate at which they've reopened, different lockdowns at different times. I would say the UK economy, broad brush, is behaving much like most other advanced economies at the moment. A sharp and fast recovery, which hasn't gone into a boom, but has certainly recovered back to pre-COVID levels of output, exceptionally fast by historical standards. But, and this is, well, it's not a but it's an and, because so much of the UK economy, indeed the global economy, is hinged on consumer spending. The composition of what households are spending on now has really shifted in the first 3.5 months of the year. Last year and the year before, households were purchasing goods, what is known as delayable spending, barbecues, garden furniture, cushions, anything the construction sector could offer in terms of home improvements, tangibles, electric goods. But notice those are now down 7% year on year. A bit of an air pocket now emerging, with households have overconsumed the things they could buy and get delivered, or the shops that were open. And the things that they've been unable to do or unwilling to do for the last 2 years, social spending, pubs, restaurants, cinemas, football, rugby, whatever it may be you want to do at the weekend that is social, involves social interactions. That spending is up more than a quarter on the 2021 average. And this real rapid rotation towards people wanting to travel, want to be entertained, want to take on hospitality, is why consumer spending, if you want, just looks at retail sales and what people are buying in terms of physical goods. You might go, gosh, this looks like a consumer recession. But pubs, restaurants, hotels are telling a very, very different story. So there's been a radical, big shift in consumer spending, which is now taking place. Why and how is that being fueled? Well, the how it's being fueled in many cases is for a considerable proportion of the UK population. The pandemic was an opportunity to save money. It isn't widely spoken about, and mainly isn't spoken about in the context of the cost of living crisis, because some of the lower income cohorts were able to save as much. But the overall quantum, if you take the whole population, means that households today have around 220 billion pounds more savings than they had at the start of the pandemic. That's about 10% of the entire output of the UK economy in a given year. And that is potentially a source of the ability for households to smooth their consumption going forward by drawing down on the savings they've saved by not going on holiday, not commuting, not going out to restaurants and to sporting events and arts. And that really has been one of the things that the UK has perhaps in its arsenal to lean in, if you like, to this cost of living crisis. Furthermore, households spent quite a lot of the pandemic paying off their most unsecured debt, not their mortgages, but their credit cards and their unsecured loans. Those were down about 7% in 2020 and a further 4% in 2021. Now, there's starting to be some signs of re-leveraging, but that's a good thing, ultimately, that they're using credit facilities potentially to smooth through what we hope is a temporary spike in energy costs. But even with those resources at play, potentially to deal with this, on a historical basis, the real income squeeze, and this is the final red bar on the right-hand side here, page 12. 2.3% real terms cut in disposable income takes out any records from the last 60 or 70 years. It's, certainly in most people's living memory is without precedent because of this big sharp cost of living increase. And that is going to be very, very difficult. And when I talk about this not necessarily being a recession in the data, but feeling like a recession for a lot of people, that is squarely what I'm describing. So just to do a sort of stock take on what that means overall for GDP and the four big components. Consumer spending, I'd mark it as amber. Yes, it's going to be under pressure from the rising cost of energy and food, but households have the ability, particularly middle and higher income households, to smooth their spending, to keep spending by drawing down on their savings and taking on credit. So it is a mixed picture in that regard. Government spending, yes, they're going to be doing less pandemic-related spending, be it free COVID tests, be it some of the furlough schemes, VAT cuts that were characterising the last 2 years. But equally, they are ramping up in the COVID recovery spending in education, in the NHS, and also in the levelling up agenda. And you're certainly seeing that in the public sector order book. In the built environment, infrastructure really very much the lead along with private sector housing. Investment I've marked green. The corporation tax super deduction, which is a real incentive for businesses to bring forward their capital investment, is showing signs of encouraging business investment in both the built environment and indeed in the intangible investment. So there are good signs that GDP, the size of the economy, will be supported by investment. Trade, I'm afraid, is marked red. Some of the Brexit effects are very, very noticeable in the data. While I didn't believe, and I have a public record of not believing some of the most negative forecasts around the UK economy that were made in 2016, I still thought it was a negative, and I thought the impact would be about 3 to 4% of GDP. That's broadly where we are getting to now, actually, 5, 6 years on. And certainly the reduction in trade volumes with the European Union because of the non-tariff frictions that have been introduced to ports and in regulation have been a real impediment to trade driving the economy. So I'd have to score that red. So I promised that the last 3 sections would be much quicker. They are much quicker, far fewer data-heavy slides. John wanted me to talk about navigating the fiscal tightrope. This is tax and spending. Well, you've heard a lot about the rising cost of servicing the public debt. Well, I'm going to talk about that and unpack it quite a technocratic way, but it's important for this debate because sometimes the debt debate gets hijacked by vested interests. What does higher inflation mean for the cost of servicing the public debt? More spending demands are clearly coming through as COVID moderates, net zero, levelling up, and ageing population. We hear a lot about fiscal rules, headroom. Fiscal rules are there to be broken. They have been broken, that's sort of party political comment. They just are. They're useful politically for a while until they're not. And public spending is almost always about choices, not about levels. It's about good spending, not the total amount of spending. What you want is to see signs of good spending, not shoehorned into a deemed budget constraint. Few charts before I sort of sum this section up. Debt interest. The debt interest on the public sector debt is expected to reach about, according to the Office for Budget Responsibility, about £84 billion this year, but I say on an accruals basis. That is not cash going out the door, because a lot of that spike is because the government gets a lot of its debt, about a quarter of its debt, through what is known as inflation-linked or index-linked gilts. It doesn't actually pay, so the amount you pay in interest is linked to the inflation rate. So clearly inflation is going up, but cash does not leave the door this year. It leaves the door when those gilts mature in 2, 5, 10, 20 years' time. And in that environment, while it's accrued today as a liability, actually it isn't cash out of the exchequer door this year. There's a really violent debate, probably too strong a word, there's a vigorous debate, let's say, amongst economists as whether what's the correct way of looking at it. But on a cash basis, it is not cash out of the consolidated account this year as a result of higher inflation. But there are many reasons why you'd be cautious, given that accrual basis cost of higher debt interest. But put that debt interest cost in its historical context, which is the right way, I think, to do. Look back over 60, 70 or 60 years on the right-hand side. Debt interest payments as a proportion of either the GDP, the size of the economy, or indeed as a size of total receipts, still broadly in line with what we've seen over those 60-year period. No sign of it decoupling to the upside. Yes, the debt stock has got higher than we've seen throughout most of that period, but actually interest rates, even if we go back to the very start of this presentation, even if interest rates went to 1.5%, 2.5%, we'd still be talking about debt service costs as a percentage of GDP, largely in line with their historical averages. I mentioned there'd be more spending demands even as COVID moderates. And those spending demands, particularly in local government, which has been the area since the global financial crisis where spending has fallen in real terms, if you're going to try and do levelling up, channeling that through local government, given the gap that has emerged between local and central government spending, is going to be a key call on the exchequer. But also look at this rather scary forecast on the right-hand side, which is from the Office of Budget Responsibility of that same debt to GDP ratio we were talking about earlier, which is about 100%, so 2.2 trillion pounds of public sector debt. Sounds a big number, it's about the size of the UK economy at 100. It's projected to go to about 4 times the size of the UK economy by 2060. If you want to worry about something, worry about that. Worry about the 30, 40-year view based on an aging population, pension, social care, healthcare requirements to keep the support levels we provide at the moment constant through that period. There is the challenge. COVID actually is a bit of you struggle almost to see on that chart what COVID has done for public finances. So long-term problem, yes. Short-term problem, far less clear that is the case. And just to finish this section on the fiscal rules, it's just to perhaps break up the charts, just to say fiscal rules, that tends to be the way governments from Gordon Brown onwards have managed the public finances. They've been broken each time. This is not, as I say, it's not a criticism of Labour, Conservatives, the coalition. Each government have done it. They're politically useful until they are not. And we're on to our 8th set of fiscal rules since 1997. And I suspect if John is kind enough to invite me back for a 3rd webinar, we'll be on to our 9th set of fiscal rules by the time we're talking about that. Fiscal discipline, which was what fiscal rules at least notionally give you, it tends to avoid they are good. They are good because you don't have the avoiding of difficult trade-offs and choices that are always there in public spending. But actually, they're a little bit of if you like, a media-friendly way of saying we have this headroom, or this debt to GDP rule, or this debt servicing rule. Actually, HMT, Her Majesty's Treasury business case process, where they approve spending or they don't approve spending, that's the real constraint. It's not very media-friendly, but that's the thing that actually controls, and indeed probably should be the thing that controls the quality of spending, because that is the real prize always with the choice of whether it's pound paid spent by the government or a pound spent by the private individual. You want the HM Treasury to be the arbiter of whether that represents good value for money or whether it shouldn't be spent, and ultimately that pound stays in the pocket of private individuals to spend how they want. And I personally think the lack of a clear tax strategy creates a bit of a phony war about tax and spending. And until we get somewhere there around a long-term tax strategy, I'm afraid we're going to be in this headline and counter-headline regarding fiscal policy. Section 3, the impact of higher energy costs. Again, a shorter section. There is huge pressure on low-income households. I skipped over it at the start, not because it isn't important, but because I wanted to cover it in this section. I think the legacy of this will be greater energy independence. It's the impact that we're seeing through net zero, through Russia and Brexit. They all point to a more closed UK-centric, domestically orientated energy system, and less reliant on either the generosity or indeed the trading relationships with energy neighbours, either in the Middle East, in Russia, or indeed in the United States. Will we see demand-side strategy for homes and transport? I really hope so, because if you want to make a quick impact, actually talking about nuclear power stations, which will take 20 years to come on stream, is less effective than insulation programs and improving energy efficiency. There is a real live debate going on at the moment around whether the taxpayer, the Treasury, will fund that in terms of seed it, trying to encourage households to be more energy efficient, or whether it should be left to them and their own devices. I can understand where the Treasury are coming from here. They see some dead weight loss, if you like, from subsidising these things, but equally it's probably the thing that will make the fastest improvement in terms of the energy equilibrium in the UK. And no doubt, October 2022 is another big moment for UK energy and the impact on household spending, because on current spot energy prices, something of the order of between £750 and £1,000 increase further for the average household beyond the energy price cap increase that took place on the 1st of April is going to come through. I caveat that by saying energy prices have been so volatile that it's even conceivable that energy prices faced by households could fall in October, such as the huge volatility. There's still a long way to run, but if prices stay anything like they are at the moment, we're in for another tough secondary hit through the energy route. The chart on the left-hand side, I haven't nicked many charts. This is the one I have stolen shamelessly from the Bank of England because they published it earlier in the week, and I really quite liked it. This shows household incomes, the richest households at the top, poorest households at the bottom, how much they saved as a proportion of disposable income in 2019-20, similar pattern in 2020 and 2021. So the top 20% saved about 30% of their disposable income that year. The bottom 20% barely saved anything. And yet, when you look at the amount that those cohorts spend on things like fuel, electricity and gas and food, it is the other way around. Only 10% amongst the richest 10% of households, but 35% amongst the poorest households. So what you have is the resources to deal with this are inversely skewed, negatively correlated to the amount from your disposable income that is devoted to those areas that are rising and the least avoidable in terms of being able to change the quality mix or shopping around. I have to say, in the context of high energy prices, what we're seeing is so unprecedented. There's a 10-year chart of the wholesale gas price. It hovers around 60-70p a therm normally. We got to about 550p a therm earlier in the year. Extraordinary moves, and nobody's model. I mean, this is my excuse, if you like, for last June, not seeing inflation on the scale. I didn't see a chart like this coming. That's because, historically, this market has been very, very stable, in a decent equilibrium between supply and demand. But that is clearly not the case right now. But even in the last few months, it has moved from 200p a therm to 550p a therm within the matter of days. So trying to know what will happen in October in terms of that secondary hit to household income, very, very difficult to know given that chart and given the inherent volatility that we're seeing. Many investors asking the question, well, do I want to be long the energy market at the moment? But there could be a peace settlement in a few days' time, and then suddenly this price, the bottom falls out of that price. So very, very difficult backdrop in order to know for certain how UK households who are ultimately paying their mortgages, their ability to provide resources into the UK housing market, heavily geared to this gas spot price. And my final section, and I thought I'd leave 15 minutes for questions. I've got 1 minute to go through the spring statement, which is about what it needs, honestly. So I called it the good, the bad, and the unfinished. The good, and everybody loves to criticise a budget or a spring statement. Remember pasty tax or omnishambles, or the spring statement was no different. Very quickly, everybody just looked at the bad. We'll come to the bad, but let's get the good out of the way. There was material tax simplification by the starting rate of national insurance and income tax being aligned at just over £12,000. That's a long overdue reform. John said, I write a column in the Times back in, you can go back and check if you so wish, in May 2020, at the very onset of the pandemic, I was asked, in a piece I did with some other economists, what would be the one reform you would do using this crisis to have a look again at the UK tax system. This was the one I picked, so I'm absolutely delighted that the Chancellor of the Treasury did it, because actually not only does it simplify the tax system, but it's also very well targeted in stopping anybody under earning £12,500 a year from paying what is effectively a payroll tax, national insurance, and income tax. It's very difficult to distinguish between the two these days. They're very similar taxes. The fact they start at the same threshold simplifies it and is well targeted in terms of tax cuts. And also, we should also acknowledge in here, there's been a rapid economic rebound. That was very clear in the spring statement, that that scarring effect that the OBR had previously feared, is unlikely to come through, but given how strong the labour market are, how many vacancies there are, how quickly employment, at least payroll employment, has returned to its pre-pandemic levels. The bad, the bad, which is this criticism that pre-election tweaking of income tax looks a bit too political and not mindful of the big challenges coming this year. Fuel duty and some student loans recoupments, both of those were quite regressive in terms of higher income households benefited the most. If you're going to give away some money, then where should you, or you're going to levy additional fees in the case of student loan repayments, particularly in this environment, mindful of that chart I showed about the inability of low-income cohorts to deal with this, would I have chosen fuel duty, student loans, and income tax? And indeed, you can go back to the bailout, the £200 loan, which has been repaid back over 4 years, which was announced back in September. That all, to me, seemed poorly targeted, given what we know are going to be the people who suffer the most as all of this. The other thing that was bad is trend growth. Once we get through the COVID recovery, prospects for long-term economic growth in the UK still pretty low at about 1.5%. That's not great, and it doesn't need much of a shock, an economic shock, therefore, to push the economy into recession if you've got low trend growth. So that's the bad. The unfinished, I think the unfinished is whether the Chancellor can wait until the budget likely at the end of October, early November, to do more for low-income cohorts. I think such will be the difficulties that many will face, those bottom 20, 30%, that he might need to do more sooner. And also potentially have to support businesses for whom some of their activities starting to become quite uneconomic because they don't have the same energy price cap that households have. So the energy price cap insulates households for a while against higher spot energy costs. Businesses tend to get that passed on instantaneously, and some of them are really struggling with that environment. So John, I think I went 2-3 minutes over. Shame on me, but hopefully a bit of time for questions.
That was fantastic, fantastic. I mean, we did get a few questions that came in alongside as well, and it's there's one that sort of ties into that sort of very last point you put around sort of October. If energy prices go up, continue going up, can the government wait till October? And that was sort of linked to one of the questions. Two things: if going also that chart around the percentage of income with the that different income groups spend on energy, food. If we end up continuing this cost of living crisis gets worse, how does that feed through? And again, whether your clients think this way into sort of lending businesses, where are they expecting arrears on credit cards, consumer loans, mortgages to sort of deteriorate? But also that exact point, will the Chancellor have to do more come October if energy prices either stay high or if food prices continue to go up, in your view? That's a bit more of a political question, I know, but...
No, absolutely fine. And I'll try and be really quick in my answers and break the habit of a lifetime, because I know we've got lots to get through. So on impairments, the current credit conditions survey from the Bank of England doesn't suggest lenders are expecting a big spike in impairments, but that is quite backward looking and hasn't necessarily evolved with the scale so quickly as these data points moved on the energy market, it is not clear that that's necessarily an indicator of the difficulties in terms of repayments that some households will face. The one thing I would say, however, is just to give a balanced view here, is while there'll be a huge pressure on households spending, the confidence perhaps that their job will still be there in a month, 3 months, 6 months' time does perhaps suggest that households will not necessarily respond in the way they did in previous, what looks like big compressions in their real income, by pulling back their spending and start to default on their debt because they still think they can service it over a longer term period. So what you might actually see is quite a lot of work regarding reprofiling repayments, so going into mediation to try and deal with the fact that you probably imagine over a 12, 24-month view, you could deal with this. But in the near term, you need some quite acute help. And the second part of your question, yes, I do think the Treasury will have to come back before October, November with a more targeted package, and probably through universal credit, which is probably the mechanism through which is most effective at getting income to those who will most need it.
Yeah, that makes sense. And then going back to sort of interest rates, sort of a couple of questions really is obviously, your forecast is around what 1.75% in 12 months' time. The consensus is slightly higher than that. Post that period, I know it's very hard sort of trying to look beyond that, but do you think the days of interest rates being below 1%, which we've used to over 13, 14 years, they're gone forever, and actually a 1.5, a 2, or even a 2.25 is the new normal? And then secondly, which is a slightly different point, but there's a number of people made a comment that if inflation is being driven by commodity prices, then actually raising interest rates is not very effective at doing that sort of inflation. And so therefore, why is the Bank of England raising rates? So two slightly separate questions, but linked together.
Yes. So I'll take the second question first. I'm smiling because it's absolutely the right question. This is the terms of trade shock. This is largely outside of the control in terms of its first order effects. If you think the Bank of England raising interest rates is going to lead to a peace deal in the Ukraine or OPEC to reconsider their volumes, you probably have an overinflated view of Andrew Bailey's power. But what he is trying to avert, and where I have some sympathy with central banks, is the idea that by introducing this inflationary shock, you get second order effects that are domestically driven in terms of expectations for what prices will look like in a year, 2 years' time. And inflation literature is rich in the idea that if you get a big shock and you don't keep control of it, the costs of having inflation running well above 2% for a prolonged period of time are much greater than the costs of doing something which you might not want to do and might not be particularly targeted right now, but they stop the costs that you otherwise would see for years and years to come. Parallels with the early 1980s in the United States. Paul Volcker, in charge of the Federal Reserve, did something very similar to that. Having answered the second part, remind me the first part very quickly.
In terms of the sort of slightly longer term outlook of interest rates, where you're suggesting 1 point, is the new normal going to be 1.5, 2, as we've got used to the sort of last decade it being sort of 0.5% stroke 0.75?
Yeah, so there's two data points to draw on here. One is the forward curves, such that people in the City of London are, and around the financial centres around the world, they are paid, they have skin in the game, if you like, to try and sign set of contracts where they think interest rates will be over a 2, 5, 10-year view. And they tend to see that when you get to those kind of levels, about 2.5% in the UK, 3.5% in the US, that levels out, but doesn't come back down by very much. It comes down a bit, but not very much. Consistent with the fact that there's still some structural long-term reasons why inflation might be somewhat higher for a prolonged period of time, even if the energy market rights itself, even if the war stops in the Ukraine, because of some of the investment in net zero, some of the shorter supply chains as a result of COVID, and the resilience, strategic resilience that is potentially going to be the plans of governments, which is generally a little bit more inflationary. So I think plateauing, but not coming back down. I think the days of sub 1% interest rates are probably gone for quite a few years now.
And on that, so your slide on, I think page 17 it was, which for me was certainly the scariest slide in terms of just that public spending, debt, quadrupling almost over the next, admittedly, 30 years. Obviously, and it's not, as you say, it's not just population. You add to that, linked to aging, increased spending on NHS and social care, and obviously with the current environment, one assumes that defence spending is going to rise as well. Obviously, the magnitude might not be significant in that sense, but the point there is, obviously that only points one way for taxes, and if it doesn't point that one way for taxes, that level of government debt, as this interest rise, is it sustainable in terms of, Rishi Sunak was talking about income tax falling by 1% in 2 years' time, or maybe 3 years' time, and do the sort of sums add up effectively? And conscious also that they're going to be fighting an election in 2 years' time, so they're going to want to deliver that tax cut.
Yeah, the sums don't add up long term. There are three ways you can deal with a chart like that. You can find the elixir, which is faster growth, so the growth gets you out of trouble. There are people, I wouldn't describe them as being in the economic mainstream, who think that lower taxes will generate that. The kind of the Lafferism view after Art Laffer, the US economist. There are areas where that has historically worked, but it's tended to be where tax rates have been very high and have come down. You can think of areas like the early 1980s in the UK as a good example, but current levels of taxation is far less clear that will be one of the things. So you hope that growth could come through, that could solve that scary chart. You raise taxes, that's an unpleasant alternative for any other government. Or you pull back on entitlement spending, look at ways to spend money more efficiently. The efficiency argument is often mentioned, but it's easy to mention it. It's much harder to do. I spent 4 or 5 years in the Cabinet Office working on this agenda. It can be done, but it's not glamorous and it's not easy. The other part, of course, is to reduce entitlements, be it to pensions or healthcare or social care, and introduce some element of charging. Again, pretty unpalatable options. Not an easy option suite for governments, honestly. I'm not sure if that gives you an answer, but ultimately, that is the thing to worry about in public finances. It isn't the near-term funding crunch, if you like.
Fantastic. Well, we've got time for one more question, and so this is probably the most popular question, and I think it's probably the hardest, and I don't like putting you on the spot, but bear in mind, obviously, we're a sort of buy-to-let mortgage lender, and obviously a lot of people on the call are related to the housing market and mortgage brokers. And so what a lot of people are asking about, what's the outlook for housing prices? I know that's a horrible question to ask, and you've given your outlook a little bit on interest rates, but in terms of your view now, if you could have a crystal ball over the next year or two in terms of what you think might be happening to the housing market, any view, and don't worry, we won't hold you to it.
No, so I think, the formal forecast is for 5% growth this year. But either below average inflation, if you want to present it like that, but still a positive number in nominal terms. Why would I say that? Because I still see an awful lot of momentum in that utility trade, as I've called it, which is those charts that I showed. They only really hold if households effectively do a bargain with themselves that I'm going to devote a certain proportion of my household disposable income to housing. But if you've decided that actually I'm now going to devote a much greater proportion because I actually see myself spending an average of 20 hours a day rather than 12 hours a day in my house, then that utility shift is so fundamental that actually, even though I think mortgage costs will be higher, therefore affordability constraints will be less. I think that's one of the reasons why I still see positive nominal growth in UK housing, and indeed global housing, even in a rising interest rate environment, because there's that big structural shift in what households want and are prepared to allocate to housing, which is a real legacy of the pandemic.
Fantastic. Well, that has been a fantastic hour, Simon. We covered a lot. Or sorry, that's not unfair. You covered a lot, I should say. So thank you very much for that. A few people have asked also if the slides will be available. I think that's okay, isn't it, Simon? We can send them out to those that are registered. So we will do that. But thank you very, very much, Simon, for joining us this afternoon. And thank you for everyone else for dialing in and listening to us. Thank you very much.